Good afternoon and welcome to our group audit coursework. I'm Luke.
Good afternoon, I'm Hamish.
Good afternoon, I'm Eric.
Good afternoon, I'm Ollie.
Good afternoon, I'm Jude.
Sheridan Audio Visual Limited, Sheridan AV, specializes in selling and distributing audio-visual equipment through retail and wholesale channels. The company has grown rapidly, expanding marketing efforts and acquiring new infrastructure. However, concerns exist over financial management, internal controls, and governance, including the lack of internal audit and weak IT controls. There are also legal and financial risks, such as a customer lawsuit and potential fraud concerns. This audit will assess financial processes, controls, and compliance to ensure accurate and reliable reporting.
Ethical concerns at Sheridan AV. The principle of integrity requires strong internal controls and accurate financial reporting. However, there are two major concerns that have arisen at Sheridan AV. Firstly, the weak internal controls. The lack of internal audit and poor IT controls heighten the risk of fraud and financial misstatements, undermining the reliability of financial reporting. Secondly, the revenue manipulation risks of employees have separated sales orders from invoicing. This practice raises concerns about premature revenue recognition and potential financial misrepresentation. Another ethical concern relates to professional competence and due care, requiring diligence and structured processes. However, at Sheridan AV, they have two key deficiencies. The first one is informal financial management. Employees rely on undocumented, casual calculations, increasing the risk of errors and misstatements. The lack of HR procedures further weakens the financial oversight. The lax payroll controls, with weak authentication and informal approvals, leave payroll vulnerable to fraud and unauthorized payments. The final breach relates to objectivity, which is vital to prevent conflicts of interest. Two key risks threaten this principle. The first one is the bonus schemes and incentives. Using bonuses to push sales and revenue targets creates pressure on employees to manipulate financial results, compromising reporting integrity. Finally, the conflicts of interest such as nepotism and preferential hiring undermine financial independence. This is shown in James Clark's appointment, as it was influenced by his friendship with David Sheridan, raising concerns over impartial decision-making.
As auditors, we must ensure financial reporting remains objective and uninfluenced by personal incentives. However, at Sheridan, a key risk is the bonus-driven manipulation. A performance-based bonus tied to sales and revenue targets creates pressure on management to inflate figures through premature revenue recognition or delayed expense reporting, compromising financial accuracy and reliability. Personal skepticism is vital for audit independence, yet at Sheridan, a major concern is the excessive trust in management. Informal, long-standing relationships between auditors and key personnel may reduce scrutiny, with financial documentation often informal and verbal assurances relied upon. The risk of overlooked control weaknesses, errors, or fraud increases. Auditors must work free from external pressure, but at Sheridan we've observed pressure from senior management is centralized decision-making, and reliance on verbal assurance creates resistance to audit inquiries. This can discourage through investigations, potentially compromising transparency and financial integrity.
Now we'll be discussing the key risks identified within the organisation. These include the lack of oversight with no audit internal audit team, informal processes, for example, when we found out that meeting notes were written on scrap paper or on the back of a cigarette packet. Credit management risks where customers have bad debt history and a high credit limit. The HR and legal issues with no provisions for potential lawsuits. The revenue and growth risks with aggressive revenue increase and ambitious sale targets. And finally, the weak stock controls with employees stealing from the warehouse. These risks can be categorized into inherent and control risks. This is shown through the table below. Firstly, the lack of oversight, where we see the inherent and control risk both as high. The absence of an audit committee or internal audit function means that management decisions and financial reports go unchecked, increasing the risk errors or financial misstatements. For credit management risk, this is also shown as both high. A review of the credit limit document shows that many customers with a history of bad debt have been given large credit limits. Combined with the absence of bad debt provision, this significantly increases the likelihood of financial misstatements. Next is the revenue and growth risks, which are also both at high. The company's aggressive sales targets, rapid revenue growth, and bonus-linked incentives heighten the risk of premature revenue recognition and channel stuffing, which can distort financial performance. Next, the HR and legal issues, where we see the inherent risk at medium and the control risk at high. The lack of formal HR policies, coupled with ongoing legal complaints and the absence of provisions for these claims, poses a significant compliance with financial risk. For informal processes, both risks are both at high, where key financial documents, including financial statements, are often drafted informally and then discarded, leading to weak record keeping and control failures. Finally, the weak stock control, where we can see, again, both risks are high. The poor oversight of stock purchases and theft within the warehouse increases the risk of inventory misstatements and financial losses. These risk areas have been categorized and based on their impact of likelihood, as reflected in the risk assessment table.
We've determined the focus of our audit based on analytical reviews. They're reviewing the sales cut-off procedure and confirming that revenue is recorded in the proper period, verifying aged debtor balances and the adequacy of the bad debt provision, validating and recalculating bonus allocations and the performance obligations related to the bonus, conducting a physical stock count and test their valuation methods, and finally ensuring all liabilities such as bad debt provisions and legal provisions are disclosed and properly valued.
Now we'll be aligning these risks to relevant assertions and affected accounts, a crucial part of identifying potential misstatements. Firstly, revenue overstatement, a key risk here at Sheridan AV. This can occur through premature recognition, sales recognition, or fictitious sales. The affected assertions are existence, cutoff, and accuracy. The impacted accounts are revenue and accounts receivable. Next, we have a look at the receivables and bad debts. There is also a risk around the valuation and existence of receivables if customers fail to pay. This impacts valuation, existence, and rights and obligation assertions, affecting accounts receivables and bad debt expense. Next, the payroll manipulation. Payroll expenses can be manipulated to meet bonus targets. Key assertions at risk are occurrence, accuracy, and cutoff, impacting payroll expenses and accrued liabilities. Next, the inventory misstatement. Inventory levels may be misstated due to incorrect valuation or recording errors. This affects existence, valuation, and cutoff assertions, impacting inventory and cost of sales. Finally, the undisclosed legal liabilities, where failing to record legal liabilities can distort financial statements. The key assertions at risk here are completeness and valuation, impacting contingent liabilities and legal expenses. Mapping these risks to assertions help focus our audit procedures and assure financial statement accuracy.
Now that we've identified the key risks, the next step is to design the targeted audit procedures to address them effectively. I'll go through one key procedure for each risk. To identify the risk of revenue overstatement, we will perform cut-off testing. This involves reviewing sales transactions near the period end to confirm they are recorded in the correct period. For receivables, we will send debtor confirmation letters to customers requesting confirmation of outstanding balances. Non-responses will be followed up to identify discrepancies. To mitigate the risk of payroll manipulation, we will perform payroll reconciliation. This includes comparing payroll registers with the general ledger and recalculating bonus allocations for accuracy. For inventory misstatements, we will conduct a physical count at year end to ensure the recorded inventories match the actual stock levels and is valued correctly. To identify unrecorded legal liabilities, we will obtain legal confirmations from the company solicitors regarding any ongoing potential litigations. With these audit procedures, this allows us to detect material misstatements, provide assurance over the accuracy of financial statements, and identify control weaknesses. This helps us gather sufficient evidence to support their opinion and assure compliance with accounting standards.
In conclusion, our audit approach for Sheridan AV is designed to address key risks and improve the accuracy and reliability of financial reporting. By aligning identified risks with target audit procedures, we can detect potential misstatements, strengthening internal controls, and providing assurance over financial integrity. This process will not only enhance compliance with auditing standards, but also support more informed decision-making within the company. Thank you for listening.